Hey everyone, welcome back to another Market Open live stream. First of all, seriously, I want to mention that I've missed all of you. The market sucks right now, and quite frankly, I've got a very clear choice. I've got this very choice that I can make every single day, and that is to just stick my middle fingers up at the market and not really care about what's happening and wake up whenever I want, or I could be, here at 5:55 a.m. or even earlier, because usually when I do market open lives, I'm up sometimes an hour or 2 hours before to study what's going on in the market to be here with you. And I'm choosing to be here with you. Maybe you don't like me, maybe you disagree with me, but here's the thing you're always going to get from me is the truth and my opinion about what's going on. And cool thing is, if I ever change my mind, you'll know, oftentimes immediately, which is the beautiful thing about YouTube, is we have this opportunity to be totally transparent and honest. So I'm here for you. This market sucks, and let's get to talking about what's going on. The first thing that I'm actually going to do is I'm going to start with a little bit of good news, and it's a little bit of good news that was somewhat buried in most media publications today. I kind of sometimes think the media wants to perpetuate negativity, but then again, that sounds redundant. Media negativity. So the good news that came out this morning actually had to do with business morale in Germany. Business morale rose in Germany in April. The IFO Business Climate Index came in at a read of 91.8, beating expectations of 89.1. We also had expectations on current conditions for 95.8 as a consensus. That came in at 98.2. The leaders of the IFO report, the economists there, suggested that the German economy is robust in the face of uncertainty. However, that 70, and this is very similar to what we're experiencing here, 75% of companies are reporting problems with supply chains, and that the German economy is stabilizing, but stabilizing to the low side. Now, remember, Europe has frequently had issues with too little inflation compared to the United States. So we're ahead of them in inflationary concerns. But what they do mention is that conditions in services have significantly improved, that construction is at the lowest level it's been since 2010. However, business conditions and services rising substantially to the point where certainly they don't see a recession in Q1. They don't see any indications of a recession in Q2, but then they leave the door open for Q3 and 4, so TBD. They also mentioned that 3/4 of all retailers want to raise their prices. And the big thing weighing on markets today are more lockdowns in China. The Chinese stock market's down somewhere in the neighborhood of 5%. And the Shanghai lockdowns have obviously been hurting. Even these IFO economists over in Germany suggest the same thing. And so you're seeing some of those issues reverberate through the economy as well as some other developments, such as the fact that the front page of the Financial Times today says that Putin believes that talks are, quote, at a dead end. And Vladimir Putin has, quote, lost interest in peace brokering. This is at least according to 3 individuals familiar with what's in Putin's head, which nobody ever knows what's actually going on in there. But anyway, one of the things later mentioned in the Financial Times piece on Putin was that Putin's really trying to figure out how to still be a winner in this disastrous war. Most think that's going to involve taking control of certainly the eastern regions, maybe the southeast, Donbass, whatever, but potentially as far as the entire southern coast of Ukraine. Russia's obviously given up on Kyiv, the capital. There are also now fires at Russian oil facilities, potential rockets from Ukraine going straight into Russia. So at the same time as you've got these massive inflationary fears and these Chinese shutdowns that are exacerbating supply chain issues, you've got more tension in Ukraine, though you actually did have oil moving down slightly this morning. Let's see, last I looked, oil was okay, yeah. WTI was just under 98. It's sitting at 97.41 right now. The fascinatingly, we've also seen the bond market react. If you take a look at the 10-year, it's dropped almost a full 10 basis points today. It's sitting at 2.814. I think that is going to be a temporary reprieve in the 10-year, which could short term be good for real estate. The reason I think that's a temporary reprieve is because the stock market is so red today. You've got a little bit of this flight to safety happening. And what happens when you see a really red stock market is you can see individuals move over to the bond market. They buy bonds. And what happens when they buy bonds? Well, then the yields go down. So you could see this. You could also sometimes see short covering in the bond market. A lot of individuals shorting the bond market on flight to safety days. We can sometimes see some of those shorts unwind. And when you see shorts unwind, what do? You buy, right? That's what happens. So big numbers coming out this week as well. We've got Alphabet, Facebook, Amazon, Apple reporting earnings this week. We've got the GDP results for Q1 coming out on Thursday. You also have the employment cost index coming out this week, and that's a big number that the Fed looks at that most people don't, but the Fed does. We've been showing broad-based wage pressure here. We have the next release. You could write this down as a catalyst. It's April 29th, 8:30 a.m. Eastern time. And so expectations are that we're going to continue to see broad-based wage pressure here. A lot of reports that inflation may have actually peaked in March, but that does us a little good when the Federal Reserve says, you know what, we don't really care if we've peaked. We're just going to go hawk mode here until we start getting inflation under control, which is also very interesting because The Economist ran this piece that was just in their magazine. I think it was in yesterday's issue. And the piece was called "The Fed That Failed." And they complained about how now 1/5 of Americans believe inflation is the most important problem facing the country, that the Fed has failed to stop inflation, that even though it's peaked, or potentially, we're still substantially far off from 2%. And their concern is that this is really important because in order for you to get inflation down, if inflation does tend to be more persistent, then you really have to go above the neutral rate of 2 to 2.5%. But with how high inflation is, they believe that you might actually have to see the Federal Reserve raise rates not to 2 to 3%, but which is roughly where the Federal Reserve wants to go. But instead, you might have to raise Fed rates, somewhere to 5 to 6%. Which is a level that we haven't seen since 2007. And that would move us then above the average annual inflation rate. So now this unfortunately reiterates their thesis that the Federal Reserve has never had a, quote, soft landing with inflation this out of control. So, the only two real soft landings we've got were 1984. 1985 and 1994. Now, interestingly, both of those occurred in the post-Volcker era. Most individuals, of course, referring to the Volcker era as something that will happen again. What's great, though, if there's any good news about the market now, is that you've actually got. I would say you're in. How should we phrase this? You have different things happening now than you did in the late 70s and 80s. See, in the late 70s and 80s, inflation expectations were running away. Why were they running away? Because individuals thought we were going back to wheelbarrows of cash. We were going back to the Weimar Republic days of post-World War I Germany, where, in other words, cash became completely worthless. And that was a real fear that was happening in the late 70s and the early 80s. And this is why inflation expectations were completely out of whack. Now, if you look at inflation expectations today, they're stable. They're stable, but they're high. And so this is obviously leading the Fed to be a bit aggressive here. Last week, we saw Sarah Eisen pressure the Fed, specifically Jerome Powell, to indicate, hey, like, you need prices in stocks to be lower, right? And we pretty much got everything but a yes on that one, which, not so great. However, I do want to report that the 5-year break even on the Treasury market is at the lowest point that we have seen about the last 7 weeks, we have now fallen below 3.31. I'm sorry, below 3.32%. We were at about 3.32% back on March 5th, and we've now fallen below that. That's a solid 7 weeks ago. This is really good because we have seen inflation expectations run substantially past that, and this coming back down of inflation expectations very, very important. And consumer inflation expectations are obviously very stable as well. Of course, that doesn't prevent any of the sort of bear analysts from making crazy predictions, like Morgan Stanley's Mike Wilson warning that the S&P 500 is getting ready to go into a bear market. Yeah, nobody likes that. So obviously, we're gonna let's see. We're gonna grab some fibs here. Let's see. Yeah, still trying to redo the studio a bit over here, but we're gonna grab some fibbies here. But anyway, bear market territory will mean that the S&P 500 would be down about 20% from all-time highs, which the Nasdaq briefly hit on March 14th, and that was sort of our 0% fib, hit that low. We had a triple bounce off of that, and that marked a really great buying opportunity. Unfortunately, now it looks like we're kind of heading back in that direction, which is not spectacular. But let's go ahead and take a look. See if I can get this up here. Okay. All right, let's hope it works. It does. Oh, wonderful. Okay, good. My testing worked. So here's your SPY. Yeah, you can see our 0% fib over here on the SPY was when Russia invaded. And we've got some pretty strong supports over at the 23.6 for the SPY, which is really 426. That's where we're sitting right now for the SPY. Now, unfortunately, QQQ's 23.6 got destroyed. You can see the 23.6 right here at 338. Absolutely destroyed, but we have not broken through a very, very critical threshold right here, which is this triple bounce, which in my opinion is actually the sort of the last hurrah we have to say, like, there's still a chance. There's still hope. Don't worry, all hope is not lost yet. Now, what's very fascinating is I just want to remind everyone that if you go back and look at my videos between the 21st and really the end of March here, March 21st to the end of March, a lot of folks were saying, this is it. I got to go all in. I got cash. I want to go all in. I want to go all in. And one of the big things that we'd regularly talked about was that it doesn't make sense for the market to go straight up with the level of uncertainties that there are. And so we charted this sort of dip right here, this sort of V shape right here. Now, we had no idea when this V shape would come. So we charted this V shape on the 23rd. And we charted the market going from about the 50% retracement down to the 23.6, and then maybe rotating back up to about the 61 retracement line. Well, unfortunately, I mean, and the good news is we ran further. We ran to about the 61% before falling, right? But unfortunately, we've now broken that 23.6 line. So we were expecting this kind of fall. Unfortunately, it's falling a little bit further. And this is quite sad. But this extra fall here is probably because the Federal Reserve has come out more hawkishly than we've expected. We really weren't expecting the Federal Reserve to go above 2% this year. And we had one meeting in January where the Federal Reserve decided to do nothing. And after January, we had 7 meetings in the year that we could have raised rates in. And if we raised rates in those 7 meetings, we would have gotten to a rate of about 1.75 to 2%. Well, unfortunately, now Jerome Powell suggests that we should be closer to 2.5% by the end of the year. The problem with that is you now have to come up with an extra quarter basis point in 2 meetings. Well, if you add a quarter to an existing quarter, that means we are now pricing in for 2 50 basis point hikes. And Jerome Powell told us last week, and this is why we're getting this read today, that we are better off front loading that and doing maybe a 50 in May and June, and then going to 25s for the rest of the year because inflation is higher. Now, that's obviously bad news for the stock market, but it's actually good news for inflation expectations because, folks, you have to remember, The Fed is all about inflation expectations. And their yippy yappy crappy talk is actually working. Inflation expectations, like I mentioned, are now falling to a lower level than we've had in the last 7 weeks. And you can look at this by looking at the 5-year Treasury break even. We are at the lowest level in the last 7 weeks. So this is actually a really good thing. At the same time, we are seeing those energy prices come down as well, right? So excellent to hear. So it's the government fault because of price gouging. I'd like to hear more about that one, Trader Jeff. Did I remodel the studio? Well, I wouldn't call it remodeled. I would call it destroyed and slowly getting pieced back together. So it's still in disaster mode. Thanks, Tracy, for the shout out. Have a good day. Hope you all have a great day as well. Okay, so we've also got some news on Twitter. Woo! Okay, but I need to take a little sip of some Monster first because I'm actually feeling good. All right, cheers. So, Twitter. Here's the latest on Twitter. Twitter is apparently growing more receptive to Elon Musk's $43 billion offer. Now, remember that Twitter hired Goldman Sachs and JP Morgan to advise them. Goldman Sachs, ironically, had a $30 price target for Twitter, which doesn't, let's put it this way. It's kind of funny on social media to see people say, oh, look, Twitter hired a firm with a $30 price target to advise if a $54.20 is a good deal or not. Obviously, that seems a little ironic, but then, of course, you have different departments, and you could always get other departments involved and say, hey, like, can you reevaluate? Like, is this a good deal? Well, it looks like JP Morgan and Goldman must be telling Twitter that 54.20 is actually a good deal because now Elon Musk, per the Wall Street Journal, has met with multiple Twitter executives on Sunday. This comes after Elon Musk says he has raised $46.5 billion with a mix of debt and cash. Morgan Stanley and others are offering $13 billion in debt financing. $12.5 billion are expected to come from loans against Elon Musk's Tesla stock. This is probably like a line of credit, not so terribly much like margin, but it is technically a form of margin. Plus $21 billion in equity financing. Equity financing would be shareholder partners, right? So other shareholders investing with Elon Musk, probably shareholders willing to invest anywhere between, $10 to $100 million each. So that way he could keep that shareholder count to 2,000 or fewer. The New York Times mentioned that the 11-member Twitter board negotiated over Musk's offer through midnight. Oh my gosh, a late night for the Twitter board. Wow, they actually did some work. Also, Elon Musk has tweeted that, quote, if our Twitter bid succeeds, we will defeat the spam bots or die trying. And the New York Times, after the sort of leaks that they got regarding the Twitter board, and I know some people don't like the New York Times, but the reality is the New York Times does also get leaks, which is kind of interesting. And they also got information here from Elon Musk. They got a reply from Elon Musk. Listen to this. The New York Times emailed Elon Musk asking him about the Twitter deal. And Elon Musk responded with X. Like literally the letter X, period. That's it. That's all he responded with. And he is also and now has formed the holding company X, presumably to hold Twitter. Think about a holding company as kind of like a Berkshire Hathaway. Anyway, Twitter reports earnings on Thursday, and who knows? Maybe we'll have we'll either get more details then, or maybe we'll find out that a deal will be struck today. Who knows? Then you've also got Corvette suggesting they're going to make an electric Corvette, but they're still going to have a gas version for those who want it. I hate to say it, but the guy looked like a total sleazebag on CNBC because before the show was over, after he was so excitedly talking about how we're going to have an electric Corvette and that Tesla better watch out because we got Hummers and Corvettes and all these things coming with the GM Ultium battery technology. After his segment was over, he was kind of looking off like, I did good, right? It was ridiculous. I wish I could pull up the clip, but you'll just have to take my word on it. It just seemed ridiculous. Then on top of that, we've got Consumer spending concerns that obviously consumers are going to switch to more service style spending, which of course is expected to hurt consumer discretionaries and the stock market even more. And that's the last thing we need is even more pain. But it's, I guess, the way the cookie crumbles. Consumer spending is exactly what can either make or break a recession. Remember that the big quarter, in my opinion, that we've got to be most concerned about is actually Q4. Q4, if people spend less in Q4 this year than they did last year, then you got a recession. Now, I mean, 2 quarters of which, of course, but it wouldn't surprise me. That was part of my original thesis in January. However, my original thesis in January got turned upside down because rather than consumers actually spending less money because of a freaking war going on, oh, no, they're actually spending more money. It's pretty remarkable. So that was quite unexpected. But anyway, let's take a look at how some of these tickers are doing. Yeah. Okay, so I also want to see. Let's see. I wonder if I could do this. Does this work? Nope. Oh, darn, that thing's off. All right. Well, that's not going to work. Never mind. Oh, well, you'll get the side of my head. So DWAC is down to 38.55. That comes after apparently Donald Trump was having issues pronouncing Truth Social. That is at least a rumor. I have not seen the clip of that, but that has been trending. We have, let's see, Overstock.com, $32. Oh my gosh, wasn't Overstock like way more? Let's see. Oh my gosh, yeah. I remember when Overstock was $100. That's right, because somebody came on my channel to talk about how great Overstock was. The thing's at $33. Oh my gosh, that's insane. I mean, some of the compression and valuations is just honestly disgusting. But it really, I mean, here's XBing. Let's take a look at XBing. Oh, wow. XBing, what is it now? 23.18. It's incredible. Look at that. Pinterest is under $20. I mean, support lines don't even matter. Like, we could draw all the lines we want, and they don't seem to matter in a bear market, which makes sense. You've got a rotation out of MP material, which I do find is kind of interesting. This sort of recent downtrend that we've had here on MP, it's been really straight down for MP. They've been quite a run. CEO was on my channel, and I encourage you to watch the interview. I actually think it's great interview and very interesting company. That interview took place back when the stock was trading for around, I believe, $32 a share, which is quite wild. Take a look at this. Roblox bouncing along that 0% fib. This is the same bounce that we had on March 14th. We are now there on Roblox. Is anything green today? There are a couple things green today. Let's see here. We've got, what is this? Centro. Very good food company is 35 cents. Oh my gosh. Full on penny stock here. Tattooed Chef sitting at $9.45. Twitter is actually up 4.74% on Hopium that we're going to get that 54.20 deal done, trading for right now 51.25. Coca-Cola up 1.5%. Seems like a little bit of a flight to safety there. Hippo up fractionally, but still now penny stock sitting at 170. Actually, not a terrible company, but boy oh boy, just anything profitless right now, you can't touch it. You just can't touch it. It doesn't mean they're not good companies. You can't touch it. You need profit and growth. Really, the only company that just absolutely crushes everyone right now seems to be Tesla in terms of growth. And that explains why we're having such a rough time getting Tesla to actually break below the $967 level, which is the 50% retracement. We've bounced off of this multiple times. It's really a sign that you've got some serious buy dipping happening there every time it goes there. Let's listen in to Jim.
Full sell-off. Thursday's NASDAQ.
Man is a plan, right? Man is a plan.
Fire.
Look, I think Twitter, if you read his feed, he's like the way it was supposed to be. Hey, it's fun. It's engaging. Maybe he'll answer you. Maybe he won't. Now, my Twitter feed, on the other hand, reminds me very much of as if I were, let's just say, in some sort of concentration camp, which I don't have any desire to be in.
Well, there's a lot of negativity, Is that what you're saying? A lot of hate?
No, I'm saying there's a lot of scatological comments. Now, I'm not alone. There are people who leave Twitter all the time because Twitter allows, remember, Twitter wants engagement, okay?
Did we just hear Jim Cramer call his Twitter feed a concentration camp? I think so. It was quite odd, but also kind of an indication that there's nothing else to talk about. Let's go ahead and jump on over to Bloomberg. And let's see what Bloomberg's got to say. Let's listen in here.
EV is just going to be off the charts across the world, right? If transportation and power generation, John, are the two areas where we need to get carbon down dramatically. EV addresses the transportation, and if you look at projections, you even just look at the sales this year. It used to be 1 million EV vehicles a year. Now that's being done in a matter of months. So the production and the demand is going to expand considerably around the world, which is why Tesla is uniquely positioned. They have production platforms in each region. Nobody else does. Just look at their ability to produce this quarter versus the traditional auto names, which have not been able to make the move and then establish their supply chains for lithium, for copper, for nickel, the things that go into the batteries, and so for semiconductors. And so to me, it's a different ballgame. And I'll just quote the Morgan Stanley analyst who said, when we look at Twitter's recent results, our concerns are for the ability of the rest of the industry to catch up. In other words, Tesla.
Yeah, I mean, I was not expecting to jump over here to Bloomberg and hear a Tesla bull jumping in here. But one thing that he says that's really valid is that Tesla has these facilities closer to where raw materials are, spread more diversified than probably any other manufacturer in the world. Even so, at this point, which is quite remarkable, because you look at Toyota, they used to make somewhere around 950,000 vehicles per year. Per month. 950,000 vehicles per month. And now they're down to about 750,000, which is more than 20% decline. It's insane. And it really follows the substantial supply crises that you have. And the fact that Tesla is not missing earnings during this sort of time, absolutely insane. Imagine if we didn't have the supply chain issues. Nutty. Anyway, I do want to shout out Eric here. Eric says, driving to my firefighter job in the city of South Lake Tahoe. And you're live. I love it. I've missed you, Kevin. Have a great morning. Thank you so much. And thanks for what you do. I was a police explorer, and I was always jealous. I wanted to do more firefighter ride-alongs. I've only ever done one. And it was it's really incredible. Incredible work y'all do. Hard work. So, okay, let's see what else we have. Okie dokie here. So, all right. Well, yes, the market is poopy doopy. Oh, but whatever. What are you gonna do? You go through bear market times. I don't know. I'm not as bearish. But I know there's a lot of FUD, fear, uncertainty, and doubt. But that's all right. So let's see here. Let's try to understand maybe from the Wall Street Journal what's going on in Beijing. How about that? We'll do that together here. So let's jump in here. We've got what do we have? We've got about 6 minutes until market open. Great. And this is a 7-minute article. We're not going to only spend time on this, but let's give it a little skimmy stoodle. So residents of China's capital stocked up on essentials as fears of a citywide lockdown grew. Oh, great. Okay, who remembers March of 2020 not being able to find toilet paper? It sounds like that's literally potentially now happening in Beijing. It blows my mind that they're still so wild over COVID when Omicron has been shown to be so much more benign. Obviously, it still substantially affects certain demographics, but boy, oh boy, what a difference from certainly from like Delta or things like that, right? Municipal officials mandated 3 rounds of mass testing this week for Chaoyang's 3.5 million people following a surge in new infections. 20! Oh my gosh, folks! Oh my gosh, folks. We got a surge in cases. Listen to this. We got to test every of 3.5 million individuals because, folks, we have 29 positives. Oh my gosh. That's 8 more. That's 8 more than the previous 24-hour period. That's it. We're going exponential here, folks. Shut China down. My gosh. I can't believe this is what's leading to this. This is partially what's causing this. I mean, look at the futures here on Bloomberg. S&P down almost 0.5%, 0.48%. NASDAQ 0.45%. Russell, I missed it, but not good. Ay. All right. So new cases and China's financial capital dipped to, see, this is more like it, 19,455 on Monday. Shanghai's government said this is in the financial capital, so this will be Shanghai. Shanghai, obviously, much more than the 28 in the other. Nationwide, about 20,200 new cases. That's throughout China. Chinese health authorities are also have also announced 51 new deaths, all in Shanghai, bringing the total to 138 since the first COVID fatalities were reported in the city, April 17th. Chinese stocks fell the most in more than 2 years. Shanghai Composite and the CSI 300 indices closed down 5.1 and 4.9% respectively, especially as economists have slashed their projections for Chinese expansion. And the IMF last week cutting its 2022 growth forecast for the country to 4.4%. Wow. Oh, yeah, look at that. Got some empty, can't get your lettuce. Empty trays of lettuce. All right, we got about 2.5 minutes to go here. Let's take a look here. I don't see that on. Does somebody here suggest that maybe Twitter has responded? Let me see here. I will see if I can get any kind of news on that. Let's see here. My mornings aren't complete without the market open streams. Oh, thanks for saying that. I'm here for the skimmy stoodle. Oh yeah, there you go. Don't forget the masks. Oh dear. Thoughts on Disney? I'm not a Disney Vacation Club member. I like when there's FUD usually. But it creates buying opportunities. But yeah, I don't actually see any news here on the Twitter bid. Not yet. So TBD, I suppose, what's happening here. All right. So let's go. Is the Fed going to get ahead of inflation? The best thing you could hope for is that the Fed doesn't have to get ahead of inflation, because if the Fed actually has to get ahead of inflation, folks, they're going to force a recession. That's not good. If we actually start getting some, serious Fed talk that they're going to be serious about getting inflation down over time, and then inflation actually starts going down and inflation expectations go down, that's the best you could hope for. You do not want the Fed to have to squeeze inflation out of this market. That would be the worst case scenario, because the Fed squeezing inflation out of the market is only done by forcing a recession. However, if the Fed keeps inflation expectations constrained at the same time as inflation starts going down, that would be very good. Blackstone also this morning reported an acquisition of a real estate firm, quite a large one. They were buying $7.6 billion for 28 million square feet of residential and industrial real estate. Kind of interesting. Autoblog, Twitter set to accept Musk's $43 billion offer, sources say. Set to accept. Well, TBD, I guess. Exactly. But let's get the opening bell here. Let's listen in.
Input costs that people are afraid of, box, glass, scene wrapper, and then, of course, the actual fundament of what's in the box, and then the trucks. A quadruple play against it.
No, they are saying growth. Coca-Cola, Kimberly-Clark, P&G all had good quarters. There's the opening bell. CNBC's real-time exchange. Here at the big board, it's Kimball Tiger Acquisition Corp. celebrating its recent listing at the NASDAQ. It's WSFS Financial celebrating the 35th anniversary as a public company. there. And as we look for the open, it looks like, Jim, the only two sectors that are positive this morning, consumer staples and utilities and real estate. So those are the defensive sectors still working.
Can we talk about Kimberly for a second?
Yeah, Kimberly. With
yeah, that is about 85% right. All right, let's take a look at the opening candlesticks here. So here's Tesla bouncing around that 980 level. Let's take a look at the QQQ sitting down about 0.56%, 0.58% now, 0.6, bobbing around, rotating slightly down. Enphase down another 4% on Enphase. Look at that drop on open over here. Youch. Oh, and Tesla just lost another $4. There goes any hope of that green candle holding on. Remember, the open tends to be pretty dang wild, though. What do we got going up over here? Cleverleaf. We got some smaller cap companies over here. Be careful with the small caps over here. Especially in this kind of market, you get some insane moves here. Where's my market cap? Should really move that over to have that pretty readily accessible, but I don't. Well, where's market cap? What did they do? Oh no, my market cap is gone. Yeah, look at that. But we can add that. I'll handle that later. Okay. So, look, Affirm's actually up 2%. How long is that going to last? Anyway, looking at the downside, Owlet down 10%. Overstock, there's that 5%. Neo, what's Neo? $17 right now. Cardano 85 cents, which that actually reminds me that if you have not yet considered trading your crypto on FTX, make sure you go to the link in the description down below and check out FTX, because they integrate trading views, technical analysis software directly into FTX. You get some free bonuses when you sign up with FTX. Check those out via the link down below. Enphase, not down that full 4% anymore. I'm kind of curious just to see how the first few minutes are going to go. Yeah, starting to get a little bit of that rotation back up. Oh, look at that here. Look, there's Tesla. Just gained about 10 points on a single candlestick here. There's that QQQ actually rotating back towards that green direction. Very, very good. Okay, I'm now getting multiple more reports here about Twitter set to accept Elon's offer. Let's take a look at Twitter. I think it's up about 4%, 3.3%. It's really interesting because the buyout is expected to be $54.20, and the fact that it's trading for $50, about $4 shy of that, nearly 10% shy of that, is quite interesting. Dogecoin soars 15% as Musk Twitter deal to be reportedly finalized. Okay. Alrighty then. Do you think the rumors of a firm takeovers? I've not heard that, but you know what? Let's take a look and see if we can find out. We'll look at the Bloomberg term and see what they say. Oil futures extend losses. U.S. crude down by $6 per barrel. Morgan Stanley, no, that's boring. Just reading the tape. Russia expels 40 German diplomatic staff in tit-for-tat move. All right, let's see what we got on Affirm news. So, Affirm. Shareholder lawsuit. Jeez, man, come on. I don't see anything about that. I do see, look, Motley Fool could Affirm be the next PayPal. Affirm's trying to be the next Visa. All right, let's, I want to take a look at the 10. Let's see, 10-year, the latest 10-year I have here is 2.82. I want to see if that's updating. Let's see here. The bond market. Oh, no, yeah, it's down. Okay, I need to hit update on that. Let's hit that again. Yeah. There we go. Okay, now it's updating. So 10-year sitting at 2.8, potentially getting ready to sneak under 2.8. So we'll see what happens there. I scrolled past the market cap column. Oh, thank you for saying that. Silly me. Twitter now bouncing around that 4% level. So we'll see what happens there. Break evens still lower on the day. Really good. Okay, let me see what the suits are saying. It's always fun to see what the suits have to say. And I don't mean Jim Cramer either. Bonds will likely get help from pause in hawkish talk. The Federal Reserve speakers are in a quiet period, and investors are starting to think about month end. These two things should keep Treasury susceptible to a corrective rally. The Fed started its self-imposed blackout on Saturday ahead of the May 4th meeting. Oh, thank God. The Fed is shutting up until May 4th. No more Fed. The Fed won't be talking until May 4th. This means the FOMC participants and staff will refrain from speaking publicly about monetary policy until the Thursday following a meeting, or May 5th. Stocks down 5.7% month to date, and bond yields are the highest in over 3 years. And that's likely to push investors to further shed stocks in favor of bonds, lowering bond yields. Ooh. U.S. consumer health can help staunch stock bleed. This week's mega tech earnings are rightly grabbing attention as last week's rut continues, with Tesla and Nvidia among the top decliners by a value ahead of the bell. Consumer stocks, on the other hand, look like they're about to get a lift. The latest results show healthy demand and robust spending. Yeah, this is something that we've been talking about. A lot of robust spending. I mean, I'm so blown away that people keep spending money. I don't know where people get all the money from. Look at this. QQQ's almost gone green. Oh my gosh. It's a sign, folks. It's a sign. We start the live streams again. We got to get QQQ to go green. Let's go. Look at that. Enphase is only down 0.8. Tesla's sitting at 986. Trade Desk is holding on to $60. Affirm is 2.7 on the upside right now. Twitter doesn't really know what it wants to do. Dogecoin's actually only up about 6.6 right now, but then again, always depends on the time frame we look at there. Carvana, oh man, are you serious? Carvana's $76, dude. Wasn't this like a $200 stock? Holy crap! Carvana went almost to $400. Holy crap! It's at $76. Oh my gosh. It is literally lost $300. See, look, 376. Now it's just 76. I don't even want to do the math on that, but I'm going to do it anyway. That is a decline of 80%. Holy crap. That's insane. I mean, in order to go back up, what do you need? Like 4x? No, more than 4x, right? 76, 4.9x. OMG. Oh my gosh. Okay. So let's see here. Oh, Coca-Cola just came out with earnings. Okay, I want to see these. Hold on a sec. Let me see if I could just get the summary on it, but I'll read the earnings call later. Okay, so that was American Express. No, they didn't do it for Coke. Well, I'll still get a summary here. Okay. I'll do a quick summary on American Express as well because it'll be good to know. Coca-Cola shares are up as much as 1.6% in the pre-market after the beverage company reported what Bernstein called a blockbuster 10% EPS beat and a quite remarkable 18% advance in organic revenue. Coke maintained its full-year guidance, which may cap a stock rally. How interesting. There could be a case made that the forecast has implicitly increased because though the headline numbers stayed the same, they now assume a 1 to 2% impact from the Russian market exit. Okay. Incredibly conservative to us, blah, blah, blah. Came in at EPS of 64 cents versus 58. Yeah, that is about 10%. That's incredible. Unit case volume up 8%. It's because Jack started drinking Coca-Cola. He's in love. Nutrition, juice, dairy, and plant-based beverages. Case volumes up 12%. Plant-based beverages. Wow. Nutrition, dairy, and juices. I didn't even know Coke did that stuff. Hydration, sports, coffee, and tea unit up 10%. Wow. Very interesting. Okay, and then American Express, which we briefly talked about at the end of last week. Executives told analysts they see further opportunities to spend more on rewards and engagement. The increased spending on new perks and rewards have led to a record level of acquisitions for Platinum customers and business cards, up 14% on net card fees. Consumer spending on American Express's network soared 30% during the quarter. I mean, that's insane. Like, how could you have a recession when credit card spending is up 30%? You can't. Unless, of course, it goes negative in the next quarters. It's like, all right, now we spent all our money. However, American Express doesn't seem to be making that bet. American Express, quote, is betting that consumers will borrow more, which combined with the effects of higher interest rates should buoy interest revenues this year. But it will force the company to set aside more in reserves. Okay. See what Jim Boy has to say.
So if we did get 75, for which Bullard has sort of put out there, I don't think it was his base case.
No, and they won't do it. But we don't want to sit here and have water dripping and water dripping. We need it done. Okay? We need the mortgage rates go to 5.5 and people are no longer 27 best and final. No, I'm saying, but we need people to say, I got my lock-in. I'm not, I got my mortgage, so therefore I'm buying a house. That's what people do. They get their mortgage to buy a house. You need people to say, you know what, I'm not getting my mortgage and I ain't buying a house. We also need, what I feel bad for Jay Powell is this work from home has created the two home situation. Mm-hmm. So people almost feel like they have to have a second home who are wealthy enough. And then you have Brian Moynihan's number where people have a couple $1,000s and now they have, say, 10, 12,000 of which they can live on. Thank heavens, because we have ways to be able to live in this country.
So Jim Cramer calling for 5.5% mortgage rates. Well, we're at 5% right now. So, and if your credit's a little lower, you're well over that already. Someone here says people are using credit cards because they can't afford gas. Some people, that is probably very true. Unfortunately, that is, it seems to be the lower income demo that gets hit the worst there. So let's see here. Ooh, this is an interesting one. Okay, I've never even heard of this title. A chief market technician. Wow, I want to be a market technician. What do you have, like a wrench? At MKM Partners wrote in a note, we have nearly a third of the S&P 500 and half of the Dow set to report. Bottom-up drivers will either confirm or reject what the challenging macroeconomic backdrop has given us. Really? Really? You're a market technician and you're basically going to tell me, well, earnings are this week and things are either going to go up or down. Wow, that is like the lamest quote I've ever seen in a Bloomberg article. Good one. And leave it to a market technician to tell you things are either going to go up or down. Oh my gosh, he's right. That's so dumb.
People being, when you look at that, my watch list, 297.
This is your watch list.
Yeah, it's my watch list.
What about Deere? Got a Bank of America took it down. They said that earnings have not peaked, but it's in the stock.
All right, I'll take the other side of that
fertilizer.
Trade.
They saw some pressure there.
Worldwide Family's calling the top. Manna from heaven.
Heard back from 40 dealers, and less than 40% plan to order more equipment this year versus 57% a year ago. Well, that was sort of surprising to them.
All I can say is that the farmers are a protected class. Anytime you ever have a decline in inventory, they increase the inventory. I think that AGCO told a very positive story, much more worldwide. Tremendous, 13% of the calories in the world come from Ukraine. So you have to plant furiously away from that. There is a soybean. There's a real problem with soybeans in Brazil, but I just don't want to get rid of this ag trade. I think the
QQQ, by the way, very, very temperamental right now. It almost went positive here. Now it's back down to 0.64 to the downside. Enphase was literally just positive and just rotated down to about 0.75% to the downside. Tesla rotated, same thing, kind of bobbing around here, 981 right now. So really quite an interesting day. In terms of the market trying to really figure out what to do. It almost seems like you have a tug of war going on between the buy the dippers and institutional selling here, fear selling. It's a lot of fear driving this market right now. It's quite sad. It's also quite sad, honestly, that even though SoFi's got some nice green bars over here, it's still red on the day, and it's at $6.36. I mean, it's just a constant bleed out here. It's quite terrible. Yeah, and there is a lot of talk about. Here's somebody, Daniel. Welcome. Thank you for joining. You've got to mention here a lot of wheat is in the field in North Alabama. How interesting. A lot of wheat fields in North Alabama. One of the things the Economist talked about wheat not too long ago as well, maybe a couple of weeks ago, is they were talking about how America doesn't have a lot of excess capacity for really producing more wheat or food commodities, because a lot of the land is already being used for that. I don't know how much I believe that. I see plenty of land around, but then again, I who knows? Maybe it's not as I say, arable land. Anyway, Ukrainian presidential advisor says Russia continues to attack Mariupol steel plant, where fighters are holed up. Okay. Reading the tape here. Doesn't look like there's anything spectacular, but a lot of people paying attention to Beijing and Ukraine. Headline also the top of Reuters right now is that Twitter is set to accept Elon Musk's $43 billion offer. We'll see what happens here. Graphic chip prices drop, raises questions on whether the end of the shortage is in sight. Well, hot damn. Now, that here looks like something I want to take a look at. You should make a video on the farmland Bill Gates is buying up. Yeah, no kidding, right? Jeez, man. All right, let me take a look. I'll take a look into that. But let me also, I want to start with what we got over here. All right, so Reuters. Let's go ahead and in the meantime, we'll throw up QQQ, and then let's see what this Reuters. Oh yeah, QQQ now down 0.8. Look at that. Come on, it almost had a chance there. Almost had a chance. All right, so a sharp drop in graphic card prices could presage an unexpectedly quick ending to the global chip crunch that has crippled manufacturing from smartphones to cars, and the issue will be a central one for companies reporting this week. As Intel, Qualcomm, and others report, investors will weigh how dampened consumer spending from inflation, China's COVID lockdowns, and Russia's invasion of Ukraine balance out supply. The trigger is a drop in the prices of GPUs, or graphic processing units, which are the brains of gaming machines and spreading to other uses. Analysts have recently downgraded NVIDIA to neutral as chip prices have fallen. So far, NVIDIA is down 31% and AMD is down 37%, as well as a 22% drop in the on the Philadelphia Semiconductor Index. GPU prices are still being sold at a premium, but a smaller one. The markup for GPUs has fallen to 41%. Oh, that's interesting. 41% markup from 77%. And graphics chips and hardware news sites, which track graphic prices, reported that prices of AMD's RX 6000 and NVIDIA's RTX 30, both used for gaming, dropped steadily to less than 20% above MSRP on resale. All right. Vicious cycle. Demand for GPUs may also be dropping because cryptocurrencies like Ethereum are expected to change the way they operate, obviously moving over to proof of stake. And Bank of America said the weakness in gaming or cryptocurrency mining segments could be balanced out by strength in data center demand. It's reaffirming its buy rating for NVIDIA. Intel, Taiwan Semiconductors planning multi-billion-dollar expansions despite this slightly negative news there. Okay, quite interesting. All right. Let's see what else we have. Okay. Poor retail guys buying it open. Well, maybe. I mean, I personally, I don't like doing anything at open, or I like buying the dip usually right before close, because that's when all the institutional weenie babies come out and start dumping. Little pansies. Uh, all right, let's see. Bloomberg's talking about Blackstone. That's boring. We've got the S&P underperforming QQQ, which is really quite interesting. Look at that, QQQ down 0.3, S&P down 0.87. Now, there's this potential that you could have this divergence in the NASDAQ and the SPY, because the SPY does have more consumer discretion than the NASDAQ technology index. The NASDAQ 100 versus the S&P 500 versus the Russell 2000, those, of course, being the big indices that we tend to track. Wow, look at a firm up 4%. And Enphase just went green. Let me see if there's any. I'll go back to a firm news here. No news on a firm. Republicans cheer possible Twitter Musk deal, hoping Trump will return. I do believe there was talk about Elon Musk specifically trying to get Trump back on the platform. Look at that. Come on, QQQ. Let's go green. We can do it. All right. Let's see what other headlines we have here. So that on chip prices is actually very interesting. I'm very, very optimistic about that. Come on. Back down to 0.3 to the downside here on QQQ. Lame. Anyway, that chip pricing information, very, very interesting. Germany to hike 2022 inflation forecast to 6.1%. Yikes. Okay. Now, Mexico's main stock index extends losses, falling more than 1%. Oh my gosh, 1%. CNBC is on commercial, still down about a third on QQQ, and 5-year break evens now, falling again, now at about 3.3. Let's go. That's actually a good thing. 5-year break evens falling at the open. I like to see that. The 10-year treasury is also falling, sitting at 2.77. This is a substantial drop here from the near 3% that we hit. So you're definitely seeing that flight to safety is a quick run to safety. Now, then you've got, let's see here, the suits. What else can the suits tell us? Well, let's find out. Test them back to 990. Brazil's central bank wants to shift market expectations, converting its view that inflation is close to peaking. Wow. Really? Comments from the central bank president and other Brazilian central bank directors last week were seen as dovish. The fact that some of them failed to acknowledge the acceleration of inflation in their presentation surprised investors, potentially meaning the end of a tightening cycle is back on the table again for Brazil. Inflation still 12% year over year in Brazil, but indications are now pointing that Brazil may signal a pause in their hawkishness. That's how great would it be if we could get the Fed to just, raise a little bit and then just go, all right, now we're announcing a pause. Be nice to have a nice little pause rally. All right, yields remain in focus. Of course. Yeah, yields are in the 10 years really rapidly falling right now. It's down 12 basis points. And Brent is almost down 100. WTI now at 96.6, down about $5.47. Brent down $5.50. Natural gas stable. We've got BTC sitting at 38,865. Ethereum sitting at 2871. Make sure to go to FTX. Check out the link in the description down below for our partnership with FTX. Dow Jones still down 0.75%. S&P down nearly 1% at 0.92. Nasdaq's bouncing around that 0.4 right now. Russell down about 0.73. All right, what else are the suits telling us today? The suits say nothing. Talked about Brazil. The peaking inflation expectations. How wonderful if we could actually get a peak in inflation. Blackstone's deal of PS Business Parks, huge, 28 million square feet. In uncertain times, it's all about guidance. Yeah, company guidance can be huge, especially this week. But I don't know if we're going to get guidance. Usually Apple doesn't guide. And neither does NVIDIA or AMD. A lot of the ones that we really wish would guide just don't guide, which I always think is quite annoying. Hedge funds cut China stocks to zero in a year worse than 2008. Yikes. Activision misses estimates on lackluster Call of Duty. Really? You know, gaming has gotten hit hard. Let's take a look at this. Or I'll listen to it. Activision Blizzard, the US video game giant that's being purchased by Microsoft, reported earnings and revenue that missed estimates, largely due to underwhelming performance of last year's Call of Duty. Adjusted revenue in Q1 fell 28%, the company said in a statement Monday. Analysts had expected $1.81 billion. They only brought in $1.48. The miss follows November's launch of Call of Duty Vanguard, the latest of Activision's, which the company said hadn't performed as well as expected. The World War II shooting game's poor showing was partly due to competition from Halo and Battlefield. But Vanguard also received mediocre reviews. After disappointing reception, Activision will release a new Modern Warfare this year, but is planning to skip a Call of Duty for 2023 entirely, making it the first time the franchise will be without an annual mainline release in nearly 2 decades. Instead, Activision will focus on 2022's Modern Warfare game and other spin-offs. The biggest video game company in the United States, Activision, also owns franchises like Candy Crush and World of Warcraft. The company blamed its poor results in part due to delays in Warcraft's production schedule. Oh, I miss playing WoW. Who would rather be grinding in WoW right now than watching the QQQ down 0.5%? I don't know. I don't know which was more fun. Or they both suck. All right, what do we got over here? What's Sarah saying?
Bucking today's market downtrend after a beat. We'll talk to him about the outlook. Squawk on the Street. We'll be right back.
Oh, nothing. I'm just gonna run and go to commercial. No problem. We got Bloomberg.
Authorities really have a choice but to stick with it, given the capacity of the healthcare system. Would you agree that that is what investors are zeroed in on at this point in time?
I think zero COVID and the potentially a big policy error is just one aspect of the China sell-off. That's the short-term economic cost to China. But people are, especially global institutional investors, they're focused on the medium term and the longer term of what China becomes. So, and the global environment is very fluid as well. So in China, domestically, you've got this COVID and a kind of a very absurd policy try to crack down the COVID, and then medium term, people really don't know what's a clear path to get China out of this COVID situation. And then you've got October Congress taking place. So domestically, we are looking ahead of a couple of potentially very volatile months. But then geopolitics, global macro job. You've got a major war happening in Europe, and you've got a U.S. potential recession coming up mid or later 2023. On top of that, the Federal Reserve is raising rate. And China, on the other hand, the central bank is trying to stimulate via monetary policy by lowering rates. So the world is a very complex place, and China is indeed in a very tough spot.
Yeah.
Is there an economic solution given the policy toolkit, whether that's fiscal or monetary, that Chinese authorities have right now at their disposal to deal with what perhaps you are alluding to there, a crisis of confidence?
Yeah, I think, of course, there are policy tools available for policymakers, but I think it's limited. On the monetary side, we just talked about this. I mean, you've got the Fed raising rate, you've got,
Yeah, just regarding China, it's worth noting that Xi Jinping is very much for this one party, obviously one party control, the Communist Party of China, and really standing by their beliefs and their efforts. So when they say, look, we have a COVID zero policy, they don't really care if they just have to print more money to try to stimulate the economy while at the same time maintaining their principles of COVID zero. Now, that probably has horrible actual economic implications that are going to be very difficult to patch up with just Chinese money printing, essentially. But the impression is always that Xi Jinping is right, and that things will be the way he wants. So let's take another listen here.
It's really putting China in a very dark moment, perhaps the darkest moment in sort of economic terms for the last couple of decades. It's a confidence crisis in a sense that you've got the most affluent city in China have this consensus disappointment and the resentfulness towards a very nonsensical policy, right? And this time is quite different from 2 years ago when COVID outbreak just took place. This time, people's knowledge, understanding of this virus is much more advanced than it was 2 years. They had 2 years ago, and people understood this is not a virus that could be cracked down.
All right, let's pull off China here for a moment and just jump on over to take a peek at the barcoding that we're really getting here. It's not quite barcoding, but that's what it feels like. It's just almost this equal up as we're getting an equal down here. And so now stabilizing, actually not really stabilizing anything, but QQQ sitting around negative 0.8 right now, really bobbing around. Same thing here with Tesla. You've actually got Enphase that went green. You've got Cloudflare sitting at $97. Finally, over those crazy low 80s that we had for a brief period of time, but certainly down from the 120s where we've been bouncing around a bit as well recently. Twitter is still sitting at about up 4% on rumors that the Musk deal is going to go through, that the board was up all night throughout midnight to discuss a deal or potential deal and maybe accepting Elon's offer. We've got Lemonade up 2.7% today. Lemonade Insurance sitting at $20. $20, take a $20 bill and you get yourself a share of Lemonade right now. Jack Dorsey calls himself Head Block. That's what he calls his title. Elon Musk calls his new title of Head Block because that's, now Square is called Block. But anyway, a fire name for an executive. Good old Twitter. All right, let's take a look briefly here and see what they're complaining about over here.
Lockdown in China, but also
that's the wrong one.
Is using as its premise right now.
I think fairly narrow, but keep in mind of the prior 13 rate hiking cycles, we've had 10 recessions and 3 soft landings. So a recession should always be a higher likelihood outcome, especially now when you have a Fed tightening into a slow economy, up off the zero bound, simultaneously trying to shrink a $9 trillion balance sheet with inflation at a 40-year high. And
this is old news. It's very important to remember that, yes, out of the last 13 rate hike cycles, we've only had 3 soft landings. Oh, look at that like 90% red day on the SPY there. But it's also important to remember that post-Volcker, we had a substantially higher percentage of soft landings, like closer to 50-50 in terms of soft landings. So very, very different post-Volcker. So when you separate it like that, it's quite a lot more optimistic, I should say. So I'm happy about that. All right. So let's take one more look around here. Ooh, 5-year break even continues to fall. Good. Ooh, Roblox. Yeah, I'm staying away from gaming right now these days. It seems like travel is the spot to be. Down almost 13 basis points on the 10-year. So we're getting some of that flight to safety. Let's listen in a little bit more here.
This by itself. When investors look around in the current environment, they just don't like what they see. They see slower growth in China. They see the rapid spread of Omicron. In our own backyard, they see a Fed that is getting increasingly hawkish and looking to raise rates aggressively at the next couple of meetings. And so, I think investors need to recognize that they can't have all good things, and slower growth, to the point that was made earlier, could actually help us thread this inflation needle and allow the Fed to take their foot off the monetary brake later on this year. But I think these cross currents are just causing a lot of uncertainty. And that's why markets are under so much pressure.
So a question for both of you, but I'll start with you, David. I mean, given all of these uncertainties, how does an investor put their money to work right now? Is it in equities? Is it somewhere else?
So we still see opportunity in equities. The sell-off in things like the NASDAQ, we think, has created some opportunity, particularly in those more profitable parts of the growth complex. But, we're also seeing interesting things in value. Value companies have much more operating leverage than their growthier counterparts. And so to us, it's really an approach of price to earnings growth more than anything else.
Lizzie, on the same.
Ooh, price to earnings growth. Growth like Tesla. Here's DWAC. Take a look at DWAC, folks. I went on, I know it sounds crazy, but I was on Newsmax back when this was in the 90s. And I'm like, just be careful. This thing could go back to $10. And the guy looked at me like he saw a ghost. I mean, that's just what happens with the SPACs. It's just like pure momentum and crazy valuations with no actual deal or business plan yet. So we'll see how it develops. But anyway, DWAC down another 7.62%. I think people are using it as sort of like a vote on Trump too. So not a surprise. Okay, Twitter still bobbing around 4% here. Trade Desk actually up about 3% right now. That's nice to see. Snowflake, Moderna, Uber, Twilio, Unity, UiPath, Fastly, Block, all these guys up over 2%. Nikola up over 2%, sitting at $7.84. Upwork, AMD, 1.8%. Matterport, 1.6%. We're getting a lot more green right now. 1.6% on Affirm, 1.5% on Enphase. Coinbase sitting at about 1%. ARK sitting at about 1%. Dave & Buster's almost at $50, $47.30. Airbnb, $156. It's about $20 more than IPO price there. Roblox also turning positive now. A lot more green coming through the day here. What's our QQ look like? QQQ is still down about 0.5%. Tesla down about 1%. Bouncing off that 50% retrace. Well, folks, I think that about does it. Thank you so much for being here. If you've enjoyed this, leave a nice, pleasant comment down below. If you did not enjoy this, then F off. See you later. Bye.